I think it was Warren Buffett who I heard say it that someone's sitting in the shade today because someone planted a tree a long time ago.
Hmm.
And that's the way I think about insurance is that we're making plans for something that may happen in many years, and that's the way we approach the business and work with business owners.
Welcome to our middle market moment, where we speak to other professionals who help business owners build value, de risk their companies, and prepare both personally and professionally to do the deal of a lifetime through M&A. Today, I want to welcome Rob Lachance of Leavitt Group. Leavitt Group is one of the largest privately held insurance brokerages in the nation, with a mission to build, serve, and perpetuate independent insurance agencies as partners with local owners. With an extensive network of 90 agencies and 250 locations across 27 states, Leavitt Group offers a distinctive advantage with local ownership, delivering a personalized and consultative approach to commercial insurance, employee benefits, and personal insurance. With over 70 years in the insurance industry, Leavitt Group brings national strength and local trust to the communities and clients they serve. Hi, Rob. Welcome and thanks for joining us.
Hey, Craig, good to see you again.
Yeah, I've been looking forward to this. I think we're going to dive in as it pertains to insurance for sellers as they think about their risks, both approaching a transaction as well as post transaction, and how they can best manage those risks. So maybe if we could start, maybe kind of share a little bit of the role that your firm plays in helping sellers prepare from a risk management perspectives, how they should think about timelines or a phased approach to the whole topic of risk management.
Well, sure, yeah. Thanks again. Thanks for having this conversation. I've really enjoyed a lot of these. I've listened to a lot of them, and I think it's really needed in the space. So I appreciate you guys taking the leadership here. And as you mentioned, we're national brokerage with some shared local ownership, and our goal is much like the folks that you've had already spoken to. That the goal is to de-risk the companies. I think about us working mainly with the CFOs and the managers of the companies to focus on both balance sheet and income statement to make sure that that's stable uh, to produce long-term EBITDA and enterprise value over multiple years. But I guess the way I think it was Warren Buffett who I heard say it that someone's sitting in the shade today because someone planted a tree a long time ago,
Mm-hmm.
and that's the way I think about insurance is that we're making plans for something that may happen in many years, and that's the way we approach the business and work with business owners. So our core business is working with folks to make sure that for catastrophic events, whether it's actual catastrophes, weather catastrophes, or cyber catastrophes now are a thing with cyber crimes, and you can have employee catastrophes, employee lawsuits, whether it's discrimination or that type of thing. Uh, to director and officer's liability, all those type of things are examples of situations that can stretch out, depending on the statute of limitation, 3 to 6 years, right? So
Mm-hmm.
those are things that you don't want to have following your company around when you're trying to make a deal. And so um, what we offer on top of our normal insurance products, a set of transactional insurance products that will help on the sell side get more cash at close, ideally, and on the buy side just some security and an unknown quantity that they're participating in. So, and you asked about timeframes. These transactional products are really only something that you engage in 2 to 3 weeks before a deal. So it's not something that you can really plan that far ahead for
Mm-hmm.
like your normal insurance products that protect the balance sheet and income statement. So, but I would say that that if you're thinking about selling a company like your other guests that you've had on, it's wise to seek advice from somebody 2 to 3 years before this happens, from an insurance broker who's experienced in your industry, I'd say.
Yeah, there's so many facets to that, and a lot of times, I'll give you an example. We have a transaction that they had a fire 1 week after the LOI. Unfortunately, they
Yeah,
had loss of income insurance, and so I'm here to
yeah,
tell you that stuff happens, right? So,
it does.
making sure that you're covered can be the difference between getting a deal done and not getting a deal done for sure. Um, as it relates to kind of, and so a lot of that preparatory work, that 2 to 3 years, you guys come in and do an audit, you look at the risk profile. But then there's also in and around a transaction, mentioned some of the transactional insurance. One of those that has grown in popularity is rep and warranty insurance. Maybe if you could, at a high level, because I know it gets in the weeds pretty quickly here, but at a high level, maybe educate our folks as to the purpose and kind of what that covers and, um, how that might help get a seller and a buyer comfortable around the risk profile.
Yeah, sure, Craig. So this reps and warranties is something that's becoming more popular for buyers, sorry, for transactions, people involved in transactions, as well as in insurance. And depending on where the market is, right now, it really seems that there's a lot of capital that's coming into this market. So that means there's going to be more and more looser terms, better pricing, and more insurance products. And reps and warranties is one of the uh, main products that we see in transactional insurance. Actually, I was looking up, and it looks like about 75% of private equity transactions are using reps and warranties insurance, which is a huge jump from where it was 5 years ago, really.
Mm-hmm.
And so that reps and warranties is something that's designed really to deal with breaches or misrepresentations in a deal. And this can come from customer contracts, employment agreements, intellectual property issues. And so any of those issues can run into a situation where you're gonna feel better about having an insurance policy in place to protect you, because often, well, you know better than I do, and if you're working out a deal, often the indemnity package can be cause the most contention in working out a deal, just to get people to agree in this way, and so uh, you can have a cleaner, faster, safer deal for everybody if if a product like this is in place. Um, Now, what does it do? Well, practically for sellers, I just think of the reps and warranties product as being able to give them um, to eliminate the escrow or reduce the escrow greatly for the transaction and make more cash available to them. And that's what I mean. That's going to make them happier, right?
Mm-hmm.
For the buyer, uh, whether it's if they want to reduce the possibility of conflict at close, or if there's a lot of other benefits for the buyer, but essentially a buyer doesn't want to see themselves in an escrow battle or lawsuit
Mm-hmm.
against the seller or the seller's management, and this kind of puts a buffer between them. Is the way I think about it.
Yeah, no, that's very astute. I think when we talk about and one of the big aha moments for sellers when they're asked to work through disclosures and indemnification and rep and warranty issues, they're asked to make assurances, if you will, that certain things have not, will not, based on their knowledge, or will not happen in the future based on
Right.
what they know about the company. But those breaches and misrepresentations, a lot of times they're not fraudulent. They're not, you never know. Post close, someone could walk into your office and, say that something's been going on for 2 years that you knew nothing about as an owner. And so, I think the big aha moment that, a lot of sellers have is, well, I can't control that, right? That's not in my control. So ultimately, rep and warranty insurance kind of shifts some of that risk and some of the unknowns onto the insurance carrier versus you as an individual seller kind of, having all of that risk. Is that a fair assessment?
Yeah, exactly. I mean, often this will come down to deployment of the escrow, and some sort of escrow battle where there's no intermediary, and very quickly, as you're talking about, the insurance company that has underwritten the deal and given you a third set of eyes on the whole thing becomes the intermediary. So it can reduce that friction, and that's beneficial for the management of the company and for the deal overall.
Yeah, it's interesting. You mentioned, both buyer and seller and not wanting to get into lawsuits down the road. In a typical private equity deal, as it's while it may be a controlled transaction, there's still a partnership there because a lot of sellers are going to stay on
Right.
as the
Yep.
CEO
Yep.
and they're going to roll some equity. So your equity partner, suing your equity partner down the road is probably not a good long-term relationship strategy. But if there is a breach or something else, shifting that risk over to that insurance carrier, certainly from my perspective, makes it feel a lot less personal. But there's also kind of deeper pockets there if there is an issue.
Yep. Yep.
So we talked about kind of, escrow, and there's a lot of battles, right, around what's an appropriate escrow, what are the limits on that escrow. And certain things are fundamental reps that last forever, like fraud. You can't commit fraud because, obviously that has bigger penalties. But maybe talk about, rep and warranty insurance covering that shortfall in escrow, or maybe a little bit about the diligence that goes on by the carrier alongside the buyer in a transaction.
Sure. So it's not well. Yeah. So you talked about escrow, and that's part of it.
Mm-hmm.
But from the buyer side, there's also the concern about how long is it. How long are the warranties,
Mm-hmm.
and so the escrow on the insurance side, we talk about it as the limit of the policy. And
Mm-hmm.
so instead of arguing about how much is an escrow, you can really have a different conversation about, hey, what's the limit of this insurance policy?
Mm-hmm.
And depending on how you set it up, and each of these deals is specific. Each of these, just like the deals that you're writing, um, in acquisitions, each of the deals, insurance deals, is specific and can be written so that the buyer, if the buyer is taking the lead on this, can write out the warranty as long as they need to. Typically, it's 6 years, and so you get a perhaps a longer timeline for them, and they can even change the amount of protection that they want depending on so you're really not in an argument about the escrow. Now the there is a deductible, and that's the co-insurance that the seller puts in place in terms of cash, and that's a way to reduce your premium, is to the cost of the insurance is to run that to keep something in escrow.
Mm-hmm.
But so I think about it as not only the escrow amount, but also the timeline that you have. And so uh, I forgot the other question that you were kind of driving at, but
Oh, just diligence. How does an insurance carrier kind of make that determination for both buyer and seller? How do they underwrite the deal? Because you have diligence going on by the buyer, but you
yep,
also have an insurance company that needs to underwrite the deal at the same time.
yeah. I mean, this is really what you have is on the insurance side is have a group of ex bankers and people who do these type of transactions every day. There's a lot of folks on Wall Street that see the larger volumes out there, and they've been repurposed to underwrite these deals. So they're really looking for, and often I'd say this, it helps from the buyer's perspective, where you have a board of directors or a board that wants to know that you did your due diligence in the purchase of this in this transaction, that you have a third set of eyes on the whole thing, and so
Mm-hmm.
it adds another level of expertise and benefit in the deal, because now you have a third set of eyes that says, okay, this makes sense. The size of the escrow or the limit of insurance makes sense, and we're willing to stand behind and underwrite this deal along with, as if the insurance company comes along with the rest of the folks. The we can go over. I can share with you the timeline on this, but essentially, it's part of the underwriting of the deal includes getting all the documents that you're sharing with potential buyers, and audited financials and all the other pieces pre-close to get an initial indication. But that's but so I'll let you drive and tell me where you'd like to go. But essentially, they're ex-bankers looking at the deals and helping value them.
Yeah, terrific. Yeah, I think that gives, another level of comfort, right? That you've got additional diligence. And if you're shifting some of that risk, there's, some deals are appropriate for rep and warranty insurance and some may not be. And a lot of it comes down to kind of buyer and seller and flipping that coin as to who pays for what. But let's start with deal size. What
Okay,
size of deals would somebody underwrite these days from a rep and warranty standpoint?
so um, in a way, this is an easy one because anybody who wants to reduce stress in this whole situation would use it. I mean, it's being used all the way up to public companies. Obviously, a different kind of structure, but
Mhm.
in the middle market, which is where we live, and that and we see it squarely in the area of say 20 million and up to a couple of hundred million is the ideal for the what the insurance companies will call that middle market
Mhm.
segment. But there's also, like I said, since there's capital in the industry, they're actually reaching down to deals under 25 million with a product called transactional liability insurance, and these are products that are seller funded, so the seller actually pays everything, and it kind of takes a good deal of the risk by doing that for paying that. But that'll go down to even the transactions are only a few $1 million. So
Mhm.
that's for your smaller deals. That's a new product to take advantage of.
And so transaction liability is a very specific policy that's seller funded. On the rep and warranty insurance, what has your experience been? Because that also is subject to negotiation. A, do you want it and need it? Who wants it and
Hmm.
needs it, right? Is it more seller inspired or buyer inspired or both? And kind of who pays for that? What is the typical deal these days, and what are you seeing in terms of who's paying for that premium that, or excuse me, that policy?
Yeah, well, often it's most common these days that buyers are taking the lead on this type of insurance. They're demanding it because they're often in the place with the least information in the deal, right?
Mm-hmm.
Um, so as far as who pays for it, this one's fun because it's like if you're going out to dinner, you can foot the bill, or I can foot the bill, or we can share it, right? And
Mm-hmm.
because each of these policies are written specifically to the deal, it can be shifted. We'll see. It, of course, the buyer is going to be the loss payee, is going to get paid in the event of a loss. So but if the buyer is looking for different terms in the deal than the seller is willing to agree to, then often the buyer will take the lead and start chipping some of the money.
Mm-hmm.
So uh, I would say most often the seller pays for the deal, but we'll see splits and even cases where the buyer will pay um, most for the deal.
Yeah, let me see if I can recap a little bit and for our audience. So if I'm a seller, the rep and warranty insurance kind of shifts some of my ongoing liability to the insurance carrier. It frees up if my 20 or 30 million dollar deal had $1 million in escrow, it'll free up some of that so that I achieve more cash at close versus having this 12 to 18 month typically escrow hanging around for any unforeseen issues. And from a buyer, Same thing. And if I think about it from a private equity buyer's perspective, I'm going to put debt on this company. I'm going to have covenants with the bank. I'm going to need to produce a certain amount of EBITDA to satisfy some of those covenants. And an unforeseen event that pops up is really going to hurt my ability to do that potentially if I'm going to be out, thousands or millions of dollars. So my options then are to sue my partner or to go after that escrow to make myself whole, or to shift some of that liability to the insurance premium. Do you agree with that kind of macro high level view of where both sides kind of benefit?
Yeah, yeah. It actually lets you be able to kind of choose the amount of escrow that you really want to have. I mean, it can basically reduce the escrow to nothing. So that's great on the seller side because they have all that cash up front. And on the buyer side, like you said, if they only have that escrow for 12 to 18 months, well, we're talking about an insurance policy that goes out 6 years, right? And
Yeah,
it keeps
yeah.
that limit of insurance out there for that amount of time. And so the example that you mentioned, um, say a $40 million deal, um, and say you're buying insurance for typically it's about 10%. So say a $4 million limit is what the insurance that you're buying on that situation.
Hmm.
Um, Typically, the insurance companies are only asking for about 1% retention. So that means that they're only going to have to put up at minimum 300,000, 400,000 for escrow, which can actually get returned to the seller after 12 months. So for if you're paying, call it uh, around $100,000 for for this policy, which is probably where it would fall, plus other fees and stuff for the guarantee on a 6 year situation for the buyer. That's fantastic, and it kind of covers things that you would have no idea, like a fire that would come up
Hmm.
and that otherwise might uh, you know not be covered fully by the traditional insurance would and wouldn't tackle the escrow for the seller that the seller put away. So that's yeah, that's a good summary on your part.
Yeah, that's pretty significant dollars. If I use your 40 million example, that's probably going to be let's forsake around numbers, about a 5% escrow at 2 million bucks that the seller's going to have to tie up for 12 to 18
Right.
months. And in your scenario where the retainage, right, the think of it as a deductible, right, is only going to be
Hmm.
1% or $400,000, that's a $1.6 million increase at cash at close. And you've got that coverage out to the 6 years, like you mentioned. So kind of all in, how should sellers and buyers be thinking about the percentage, if you will, or the cost of that policy? Is there kind of a rule of thumb these days? I know the two things have been happening in the industry. The fees have come down because there's more deals with rep and warranty insurance. The underwriters are getting more comfortable with it. But by the same token, there's also been some more claims against rep and warranty insurance. So what are we thinking
Right.
about
Right.
fees these days?
So generally, on a sizable deal over 20 million, there's a basic fee that's around the $30,000. That's really what you're paying for is the underwriting there, the team
Mhm.
of really folks that have worn the banking hat before, looking at this deal and saying, does this look like the type of deal that we want to do? And then beyond that, there's the premium. So the premium is about 2 to 3% these days, and
Mm.
so it's been going down because the property market insurance is so rough right now that this type of casualty insurance is getting capital. So 2 to 3% of and that's not the enterprise value. That's the policy limit. So the example that we just talked about, on a $4 million policy limit for say a $40 million enterprise value, that's that's going to be right in the $100,000 range.
Yeah, so that's very affordable in the grand scheme of things,
Oh
right? And
yeah.
it comes out of proceeds at close. And a lot of times, buyer and seller, in my experience, depending upon, where the impetus comes from. We're doing a lot of deals where buyer and seller both see the benefits to it, so they end up splitting that premium. So if it's 50 grand a piece, right, to both of them, that's a
Hmm.
little bit more palatable uh, to handle these days for
Sure.
sure. What about, and thank you, because rep and warranty insurance, you talk about retainage and premiums, right? And it can get people, seeing, all sorts of things, shadows with the concepts. But I think you've done a great job of kind of explaining how that all works. What about other coverage areas that you would recommend? I know buyers are increasingly concerned with, cyber insurance. Obviously, since there's people on boards and officers, there's D&O and E&O insurance. Maybe share a little bit around some of the other products that might, I guess, in the end, it's how much you keep, right? It's not how much you sell for. So if you can increase the odds of keeping more by, reducing that risk, what are the other buckets, if you will, that you guys will underwrite to help sellers sleep better at night, knowing that, they might be involved in this company, whether it be holding a note or having an earnout or being a equity participant, help them sleep better at night.
Yeah, sure. You mentioned the items that I most commonly go to. Cyber insurance is becoming extremely important, and having that locked in for multi-millions of dollars, just like your general liability, is really, these cyber guys just don't come after anything unless they can get a lot of money out of it. Um, there's other issues, whether it's with your directors and officers or employees, negligence, discrimination, mismanagement of funds, fiduciary duty, copyright infringement, defamation, sexual harassment, wrongful termination. These are products that are covered. And if you haven't heard of them, you mentioned directors and officers insurance, employment practices insurance, errors and omissions insurance. And again, an experienced broker can really take your business and pull that apart and say where are the gaps. Um, but as far as transactions, for known quantities, say you have a tax liability or some other contingent litigation on board during the transaction, or around the time of the transaction, that's also something that can be covered. They're more expensive insurance products, but if they're known quantities, you can actually take that to the insurance companies as well. AIG and Chubb do a great job, and will you can go ahead with the deal even with a known tax liability or possible tax liability to the
Mm,
IRS, or a contingent litigation on board, which would normally just be a showstopper for the deal. Like, no, we don't want to deal with this.
mm.
And so that's another product that is quickly becoming more popular for deals that are more complex.
Yeah, and I know we've had, and increasingly, right, the states often have, and especially if you think about e-commerce companies and others where they're dealing in 50 states, they're selling all over, and states have become really aggressive in going after sales tax and the like. And I know some companies, post close, they think they have a great handle on the sales tax issue, but there's also coverage, and you intimated earlier, that will handle any kind of IRS challenge or taxation issues. Maybe spend a
Hmm.
second, talking about that type of policy as well.
Yeah, so that's tax liability. It's in this category of transactional insurance, and the tax liability policy will take any. There's even international tax. Um, in this country and in others, and tariff taxes and state taxes. I mean, that's the most fun thing that we love
Hmm.
that people love to talk about, I'm sure, in a deal. But there's coverage for that as well, and basically you have tax attorneys valuing that out and putting a cost to that in terms of premium. I think I mentioned these are more expensive products than reps and warranties, which is the claims are small, and essentially with the tax liability, if you know that there's going to be tax liability, you just don't know how big it is.
Yeah.
And the same thing with contingent litigation. You have a team of lawyers working there to help you, and to take on that risk. And again, the goal is to be able to do the deal and have this product in place so the transaction can happen. And so the insurance company is with you as part of the team trying to help that transaction go through, and for everybody to feel good about it.
Yeah, terrific, terrific. Well, maybe getting into a little bit of the nuts and bolts, and obviously, you guys work with multiple carriers, and one of the benefits of, the brokerage model is your work is shopping the policies, right? And comparing, prices, terms, conditions, stability of the carrier and all of that. So maybe kind of lean in a little bit as to kind of your work in vetting those opportunities and presenting them to the client, all within this crazy, chaotic, we need to close, we're doing diligence, this 90-day window. How do you guys kind of navigate that?
Yeah, so it's really only 2 to 3 weeks out that it happens, and first it's NDAs, so that the insurance companies and any of the folks that we're going to talk to in the market are have an NDA on them, and then the broker gets uh, uh, the draft agreement, target financials, all the confidential information memorandum, the investor presentation, audited financials, and pushes that to the market. And actually, with only a couple of days, you get multiple submissions back. And so then the broker, I would work with the company to select which policy seems best for this particular deal. Usually you'll have 2 or 3 options. Even though the market's small, there's less than 10 carriers who do this. And once the 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 buyer and the seller and the broker agree uh, an insurance carrier, um, then it's really we go with them. There's a diligence call with those guys, and the policy's drafted within 24 hours. So the goal is to not let this tax the deal significantly and to let the deal move by as smoothly as possible for it to be, but for everybody to have in their mind, okay, here's the risk we're trying to mitigate in this deal, and they're probably known at that point, and to push that off on the insurance so that so that we can just help you forget about those items and just go forward with the deal. So usually it's in the last 3 weeks, and then on signing, uh, documents are sent to the broker, and after close is when all um, the premiums paid and data room and all that happens. So it's pretty collapsed, and we can move. The insurance companies and the brokers can move very quickly.
Yeah, terrific. No, that's great. Maybe as sometimes buyers and sellers tend to be skeptical bunches, right? Especially with the pressure of a transaction. Maybe you can share a couple of anecdotes or stories or examples on where actual claims have befallen the rep and warranty insurance or the other types of insurance, just to give people some kind of real life. I mentioned, the fire and then loss of income on a particular deal. The loss of income covered the loss of income, obviously, while the one entity was kind of rebuilding, if you will, to open back up. But maybe you can give us a couple of other examples there.
Sure. Yeah. So, like the example you had, Craig, there's whether it's the traditional insurance or even the escrow, the insurance retention. Most of the times, the claims won't even pass that. So the claims in this business have been on the smaller side, and then if they get larger, examples, most commonly it's financial statement breach. So there's something in the financials, it's either sales data issues that are misunderstood, or some sort of supply chain issues, or some other complex financial arrangements um, that create a problem. Hopefully, it's not multi millions of dollars, but let's face it, if you have a customer or supplier that changed terms after a deal, then that's going to be that's going to create a problem. And often it isn't the seller's. Uh, it's not really the seller's fault, and that's why it's great to have this intermediary there. Other sources, data security, privacy, IT stuff, um, intellectual property. Those those items are items that can exceed the retention and go into the insurance policy too. So those are items that those are, I think I've named the most typical items here. Uh, if you're properly insured, other issues like employee benefits, employment contracts can trail and follow and create multi-million dollar lawsuits. And if you're not properly insured on the business side, that can go into this type of policy as well.
Yeah, terrific. Now, it's always good to know, you know, everybody is very optimistic, right? But stuff happens, like we started this conversation, and really knowing what your options are and how to kind of de-risk both, before, during, and after a transaction are really beneficial. Any parting thoughts for our audience to consider as it relates to the topic on insurance?
Um, yeah, plant a tree. That's what
Yeah,
we encourage our customers and the people that we work with to do. You know, plant a tree so you can have shade when you're talking to somebody like yourself. When you're talking to the bankers, you're talking to the private equity companies about moving your company into the next phase. Well, that's something you want to do is plant the tree. Think about a good insurance program right now, and then the reps and warranties situation at the back end should be fairly straightforward.
yeah, terrific. Great advice. Well, Rob, obviously our audience is sellers and buyers, and this is a topic that when you're focused on other things, what's the price, the terms, and all of that. But we really want to highlight the things relative to preparation. So I know you're a great resource for people to reach out to. Tell us ways to get in touch with you if folks want to ask you some more questions about this important topic.
Sure. Thank you, Craig. You said I work at Leavitt Group, and my email address is rob-lachance, Lachance at levitt.com. And it's pretty easy to Google me or find me on LinkedIn. I respond to all that stuff. So yeah, we'd appreciate any type of business that comes our way. But yeah, I'm happy to talk to you about these items, Craig, and I look forward to speaking to you again soon.
Yeah, awesome, Rob. Thank you. And thanks for joining us on the middle market moment. And thanks for everyone listening. And good luck on your journey to the deal of a lifetime.